If you own a $6 million property and you're sitting on a $1 million general liability policy, you're already $5 million exposed. One slip and fall, one eviction gone wrong, one wrongful death, and it's game over. And your LLC, that's not enough. Today, you're about to hear from the estate attorney who's protected over $1 billion in assets and hasn't lost a single dollar in court in over a decade. This episode might save your legacy.
Today's guest, that's right, that guy right there, Seth Ellis, a personally good friend of mine, and for, I don't know, a decade or more, buddy. So he oversees over $1 billion in clients' assets, right? He's protected literally hundreds of millions of dollars through trusts. He shielded dozens and dozens of families from creditor attacks. That's right. And he hasn't lost a dollar in court for 10 plus years. So here we go again, real estate profit boost. If you own real estate, this episode, and I'm telling you right now, can save your entire portfolio. So that's Seth Ellis, a legacy architect, a fiduciary responsible for safeguarding over $1 billion in client assets. Seth Ellis, that guy, is the founding partner of the Ellis Law Group, one of South Florida's premier estate planning firms. He's got a law degree from Suffolk, here, there, planning from the University of Miami. He's spent over 30 years helping families like you, real estate owners, entrepreneurs, philanthropists, secure their wealth and avoid lawsuits. He creates lasting legacies and protects you. He's not just an advisor, he's a fiduciary, a legal guardian of wealth. From real estate investors to business founders, his firm, I can't even tell you how much in money he's protected because I've already repeated myself, but it's $1 billion and more. And this includes advanced trust strategies that you're going to hear about today, including what you've heard about Nevada, South Dakota, Alaska. But more importantly, he recently just protected a family with over $5 million in creditor loss in the last 12 months alone. By the way, he's also on the board of Entrepreneurs Organization, and that's how I know Seth, a global board member, an adjunct professor at Miami Law, which I did not know. Now I know. And today he's going to show us how the wealthy really protect their real estate assets so you can sleep at night, scale faster, and pass it along to all your high net worth friends. So Seth, welcome, buddy. Good to see you.
Gary.
All right.
Great to be here.
Good. He just came back from a trip to Vegas with 14 other entrepreneurs. So he's a little, he's well rested and a little jet lagged. But Seth, thanks for joining me here. And thanks for taking me to dinner a couple weeks ago. And by the way, thank you for reviewing my trust in estates and stuff, because I had some attorney do it. And then, of course, I asked Seth to review it, and he poked it full of holes. So I'm in process as well. So you can never, when you get to the best of the best, like this guy, then you're okay. So I'm just going to go right into it, right? Obviously our client base is 90% high net worth commercial real estate investors in high risk coastal states. That's our niche, but we're spreading further and further and further. We deal with family offices and things like that. So Seth, you're overseeing over $1 billion in assets. What percentage of your clients are now using trust structures to protect their real estate portfolios? Let's focus on that.
Jerry, every client I have that's involved in real estate has a trust of some type, whether it's a revocable trust for just probate avoidance and incapacity planning, or if it's a domestic asset protection trust from Nevada or South Dakota, or even a family gifting trust where they're looking to preserve wealth and pass wealth on to the next generation. So it's a no-brainer for us. When we start off working with clients, the trust is our first go-to. That's our staple.
That's your staple. Okay, so for example, when does a real estate investor or an entrepreneur, when do they really when do they need to start looking at this, right? So bring me into because some of our audience, is a rookie real estate investor, for example. Bring me into the entry-level client for Seth Ellis and when they need you and why.
So starting at the top, when we start working with clients, the most important part is setting up the proper entity structure before you start dealing with trust or anything else. You want to make sure that when you take down your first piece of real estate, you don't take it in your individual name. So the first way that we're going to recommend is we always recommend using a limited liability company. And we typically start off one property, one owner, a disregarded entity. So the LLC won't exist for tax purposes, but it will start off with giving you asset protection. And there are two types of asset protection, Jerry. The first kind is, how do you protect yourself as the investor from the outside world? So if you were to sue me for something unrelated to the real estate, how do I protect my real estate? And then more importantly, if something happens on that property, how do you make sure that the liability doesn't flow back to the owner? So that limited liability companies give you that first structure. And then we typically recommend that that LLC is owned by a revocable trust or an estate planning trust. So if there was an incapacity or a passing, someone dies, we're not stuck in the probate court, and we're not stuck going through a guardianship if dad or mom is unable to manage their affairs. So that's our basic structure: one LLC, revocable trust, first property.
Right. Okay. So, right. Because, we deal with a lot of high net worth commercial real estate investors, and I can't tell you how many people show up asking for us for insurance. Right. And I always say in the world of insurance, the banks require wind, property, sinkhole, terrorism. All of that is a bunch of BS. Right. The biggest claim that we see on our side, Seth, and I know you know this, is a general liability lawsuit. Right. Slip and fall, ceiling fell in on my son, all of these kind of things, kid fell off a balcony. And even during an eviction process, when you're dealing with certain classes of tenants, they sue you for stuff that doesn't exist, right? So I always recommend a general liability policy, which is $1 million, $2 million. But in a lot of these cases, the property is worth $6 million, right? And by the way, in my world, the biggest exclusion on general liability policies is assault and battery and firearms, because those are the biggest claims. So how does an LLC, right, protect you above $1 million policy that may be full of exclusions, because the insurance carriers love to do that, and when it's a $5 million piece of real estate?
So I think the first part of that is going to be that the LLC, just in the nature of an LLC, it's a limited liability company, is going to limit your liability to any damages or any acts that occur on the property just based on the legal structure. So, and forming an LLC is really simple. You can go online on Sunbiz, you fill out the paperwork, and you have the LLC in place. A lot of people stop right there, Jerry. What we try to focus on is dotting your I's and crossing your T's. So even though it may be a single member LLC, we make sure there are annual minutes so that you're always talking and speaking on behalf of the entity as opposed to yourself. So we recommend that when you go out and you get your property insurance, you have a meeting, which would be memorialized in writing. We had a meeting. We talked about insurance. We decided to buy a $5 million property insurance. So that way, everything, when they look through the LLC, they won't think that you personally are making those decisions. You're speaking on behalf of the entity. The other part that's so important.
Little tricks, right? Speak on behalf of the LLC, not on behalf of Jerry Katz. Hi, I'm calling you to Jerry at Premier Protection on behalf of ABC LLC to purchase. Got it. Little details, Seth. Thank you. Go ahead. Yeah.
The other part, even if it's a 2-page document, which we don't recommend, but have a full operating agreement, which has all of the rules and regulations for the LLC, and then read it and follow it. So if the operating agreement says that you need to have a meeting once a year, have that meeting. If the operating agreement says you authorize Bank of America to be your bank, make sure that you're using Bank of America. And if you change it to Wells Fargo or BB&T or another bank, or Truist, you want to make sure that you document that internally. And a lot of people don't do that. We spend a lot of time with our clients every year, calling them up and saying, we're going to do annual minutes when we do our filing for this, with Sunbiz. And we just reaffirm officers, directors. I mean, I can't tell you, we get into litigation and all of a sudden they open the corporate book and there are minutes from 1992 and there's nothing after that. And the creditor is going to say, hey, you were acting independently. You weren't acting on behalf of the entity.
Understood. Those are the little details. You're right, because and 90% of my clients call up and, hey, this is, Ben Schwartz or whatever it is. And yeah, we do the insurance policy in the LLC, but they're talking, even our TAO calls, total asset optimization. We are asking the owner of the property or the owner of the LLC on a personal level. And we AI note those, right, for our liability, but they never speak on behalf of the LLC. They speak on the behalf of themselves. So interesting. So in that scenario, if they only have $1 million policy, right, and it's an LLC and the lawsuit's for $5 million and you have a $4 million building, how do you protect yourself there? Right? Because that's always my biggest concern is what if it's a wrongful death? Because I see those in the insurance business, right? And the property value exceeds the $1 million insurance policy they sell, like a general liability, or there's an exclusion for assault and battery and the wrongful death occurs. What happens to the property after the $1 million payout comes from the policy? Yeah.
So two things to think about. One is leverage. If you've leveraged the property and you have debt on the property, you're going to eliminate some of that fair market value. A lot of our clients will refinance their properties, often pull the money out, and then reinvest it in other safer investments that are not subject to those lawsuits. So remember, with that LLC, whatever's in that LLC box is going to be subject to that liability. So if you have if you have a building worth $4 million, that's the most that they should be able to claim against is that $4 million property. They can't go back to the owner and go after his brokerage account at Goldman Sachs that has, millions of dollars in it. It should be limited with one exception. The exception is the manager is the person that is out in the, in the front lines. And that manager, if he is acting, if he's negligent, if he's acting under, with gross neglect, that manager could have personal liability for the actions of the LLC. So even though in a lot of our families will set it up, single member LLC, principal will be the manager. He's signing all the leases. He's signing all the guarantees. He's signing everything. He's putting himself in harm's way. There are some ways that we can avoid that. And as we start building our structures, maybe we'll have a management company. So instead of Steve Smith being the manager of ABC LLC, we'll have a Delaware entity that will be the manager. And I like using Delaware because it hides the officers and directors. So now we have an entity where they don't know who that manager is. I mean, when we get into depositions, it's all going to come out. But on first shot, you're able to hide some of the digital footprints that are out there.
Your assets, your legacy, your peace of mind. Protect them all before someone else makes that choice for you.
Listen, Seth, you just blew my mind. Okay. So even with me, okay, I got 144 units, right? I have a manager that works for me. Each building is owned in an LLC, right? Separate LLC. Number one thing I heard is sometimes having debt is your best protection, right? Because you're able to cash out on that. And if you have a large debt, so if you have a $5 million building, $1 million policy pays out, you have a $5 million lawsuit. If you owe the bank $3.5 million, they force you to sell the property. At least I got my $3.5 million because of the cash out from the debt, right? And then they take it. Huge.
Get paid first.
Right. He just showed you how to leverage debt, right, to protect your asset against a lawsuit. So those are real estate investors who don't think debt, right, comes to you tax-free, because that's why we look at it. Cash out refis, tax-free, right? But it also protects you in a lawsuit. You actually get to keep that cash. But the other thing you brought up is I have a property manager that works for me, right? And it's not a separate entity. He's a 1099 and I pay him 5%, right, from each entity that's a separate LLC. But guess what? I'm still signing some of the leases. Me, Jerry Katz, and I'm the managing member of all my LLCs, right? And then he's signing some of those leases. Does that open me up for exposure right there somewhere? Because he bills me a 1099 per property, per entity at the end of the year.
No, I think you get double layer of exposure there. You've got an employee that's acting on your behalf, entering into these agreements for you. If the agreements end up being litigated, that could present liability to you and the ones you're signing individually. So I think let's talk about hiding the owner first, because I think that's another key thing. So for my large real estate families, what we will do is we'll do land trusts to take titles to the property. So now what we'll do is we'll take a piece of property down. We'll have 100% beneficial interest in the land trust, the LLC. So we're getting that asset protection piece of it. But when I search public record for 123 Main Street, it's not going to say 123 Main Street LLC or Jerry Katz's manager. It's going to say 123 Main Street is owned by the 123 Main Street Realty Trust, a non-recorded instrument. So the only thing you're going to see is the name of the trust, maybe a trustee, which you can go ahead and use an entity or a corporation. Again, Delaware is my favorite go-to state because you don't have direct access to officers and directors. So now you've hidden the ownership. And then if you're the manager of that LLC, you're re-exposing yourself. So, for privacy is probably the most important part of asset protection, because if we don't know who owns it, it's a lot harder to kind of say, let me have this frivolous lawsuit. Listen, we've seen, how many lawsuits have you seen where people are coming in and saying that the guardrail for the restroom is 2 inches too high or too low, or the diving board's too close or too far? And they're not
ADA laws.
the ADA laws, and you're seeing the same plaintiff go to the same hotel and the same property filing the same lawsuit. I've been served several times in the same day with the same lawsuit with different clients. So it's crazy what they're doing and how they take advantage of that law.
Right.
Now, I'm not saying that there aren't legitimate reasons to have ADA. I'm not saying that at all. But there are plaintiffs out there that make a profession of going out and finding loopholes in the law to sue on.
So Seth, you, I don't know if you remember, but when about 8-9 years ago, so when we insure a lot of real estate investors, as you know, they were getting all those ADA lawsuits, right? From a victim that was what I call a fake victim that would show up and say the counter's off by 9 inches. And the next thing, a lawsuit came, right? So the first thing a client does that owns real estate is calls us and looks for a protection from the insurance. Well, guess what? All liability policies exclude violation of ADA laws. So I don't know if you remember this. Because I needed a solution for my clients, right? Because we go above and beyond, right, at Premier Protection Insurance. So I called you, and you gave me the insurance guy that worked pro bono for the CFO of the state, and he designed a package to immediately settle for my clients. And it was a $5,000 fee, go quickly to settlement and get it done. So we created our own insurance policy on your recommendation with the insurance lawyer that you referred to us almost a decade ago. I don't know if you remember that.
Yeah. That's awesome. It's always good to hear the stories, refreshed. But
right.
But it makes it harder for those lawsuits to get filed if you don't know who the owner of the property is. So if you can hide the property ownership through a trust structure, going back to the original question, and have it owned by an LLC, and if they do figure out who the owner is, because again, the digital footprints on deeds and mortgages, we can start the blockade of information. But if you go to that first recommendation of putting debt on the property, that mortgage could get recorded and you're going to have your name on the mortgage. So with a little due diligence, everything can be found, but our job is to make it harder to find those pieces of information.
Right. No, that's huge, and so on and so forth. So for example, you mentioned Delaware trusts, and guys, like I have questions set up, but I'm thinking that he's reviewing my entire estate right now. So the previous attorney before a decade ago set up Alaska. So I have a holding company, right? And then my holding company is an Alaska LLC. And then we quit claimed all my LLCs, I believe, and tell me if I'm not an attorney, owns all my LLCs. And then on the holding company, my kids own 2% and I own 98%, and they're Alaska. Can you poke holes in that? Or what was he trying to do? And you know what? My old attorney before I knew you did not recommend land trusts. So tell me what he's trying to do with the pros and cons, and why are you reviewing my stuff today? Go ahead.
So conceptually, it's the right structure. So again, all these are add-ons. And good asset protection is creating road bumps or speed bumps between you and your assets so you can settle the case. I was just in Nevada talking to one of the trustees. He referred to it as build the biggest moat around the castle so it's hard to get across. That's all asset protection is. Anyone that tells you you're going to be wrapped in Teflon, you can jump off the Empire State Building, they don't know what they're talking about. Everything you can get pierced at some point. It's just how much time and how much money you want to spend. So on your piece, and what you're talking about with Alaska, I prefer South Dakota and I prefer Nevada. Their two trust statutes are almost similar. Most of my clients choose Nevada, probably for the obvious reason. But I really like the Nevada law with their statute of limitations. It's a 2-year statute. I like Nevada law for trusts because it has a long perpetuity period, how long these trusts continue. And there's a lot of literature about it, and they've been challenged. So the first layer is that single member LLC. That single member LLC, if it was owned by your irrevocable trust, that's fine, but it doesn't protect you individually from other liabilities, whether it's real estate or divorce or anything else that can happen in life. So what we tend to do is we have a real estate holding company that we would set up in a different state. So I typically will use a Nevada partnership structure, LLC, that will have more than one member. So 2 members is what we're talking about. That's why your kids were involved in it. I don't like using kids for 2 reasons. Jerry, how old were your kids when you set this up?
9, 6.
So
right.
Neither one of them had the ability to contract. So if you ever needed to have a full unanimous consent or vote, you'd have to go get a court guardianship to vote those shares for the kids, which is time consuming and expensive. So I would never put assets directly into kids' names. I would use a gifting trust. So I would set up a specific trust for each child or a family trust for both children. I like separate trusts because you can add different assets and you can do different things with it. But for ease of administration, we'll usually do a family trust, so we can have a holding trust with one trustee. So now we have a family trust that's going to own that 2% for each of the kids. You have that 99%. I'm going to come back later on and talk about the 99%. But by creating a 2-member partnership or an LLC with 2 members, you've now taken it away from a single member LLC. And the only way a creditor can reach into an LLC that has 2 members in Florida, and we'll talk about other states, is through a charging order. So if you set up an LLC and you have those 2 members and you get sued personally for landlord-tenant issue outside of the buildings, now what will happen is your creditors, think about like a boot on a car when you get too many parking tickets. A creditor puts a charging order around your partnership interest or your LLC interest, and any cash flow that comes out, any distribution that comes out, your 98%, your creditor can use to offset their liability, their judgment. So what that does is 2 things. One, it puts you in a negotiation position because they can't get the real estate. They can only get the charging order. It also, under most states, will allow you to flow the income tax liability to that creditor. So if you've got positive cash flow coming out, you're going to give them a K-1 so long as they have that charging order, because by law, they're legally entitled to that income, even though it's not being distributed. So you can suffocate them with phantom income.
Understood. And that got it. And the taxes and things like that. I mean, come on, folks out there, real estate profit boost. He just dropped like 5, 6 bombs at an amazingly sophisticated level. So why am I saying that? Put your comments below and subscribe to this now and share it with high net worth real estate investors. And if you're starting out, that's it. This is the place to do it. Great job, Seth. All right. So listen, I'm pretty, it gets you really thinking on all this kind of stuff and so forth. So obviously we could talk a lot, but I also want to touch on this, and then it'll open the conversation. How do you combine tax optimization, right, with trust design to preserve more wealth across generations or taxes or anything? Just touch on that. And I don't even know what a GRAT is or a QPRT. And I think that's part of my structure. Can you talk a little bit about drop some value here? Yeah.
So a lot of the work that we do is tax neutral, meaning that we're going to make transfers and transfer wealth without triggering capital gains and without triggering any kind of recognition in the transfers. So when you set up that holding company, you've got your 2% that you're giving to your kids. Let's say you want to transfer more wealth. So as of 2 weeks ago, under the big, beautiful bill President Trump signed, we have a $15 million per person exemption. So back when I first started practicing, it was $600,000 back in the early 90s. You could transfer $600,000. Anything over $600,000 was I think it was a 55% tax. Now you can transfer, and President Bush increased it to $1 million, up to 3.5, Obama to $5 million, and Trump went to $10 million at the end of his last term. We all thought it was going to roll back at the end of 2026. We got this beautiful gift a couple of weeks ago. We now know we have certainty in our world, $15 million, $30 million for a married couple. Take advantage of that. And most real estate families I know, their wealth is generationally increasing. So if you can take your real estate and get a valuation. So if you value your holding company, Jerry, and you give away less than 50%, when you do that, let's say your holding company with all the real estate, I'm just going to make a number, is $10 million, because I can do simple math, $10 million, and you're giving away 49 or even 50%, A certified real estate appraiser that has the right designations will look at that holding company and will say, hey, you know what? You get a discount for lack of marketability. You get a discount for lack of control. So now that $10 million entity or that $5 million gift may really be worth $4 million or $3.5 million for IRS purposes. So
Understood.
two options. Option one is you just give it away. If you're under the $30 million, you just make a gift to a family trust, and that wealth will then start growing inside the family trust. I'm going to give you another.
No, there was two little nuances right there, right? With the appraiser, right? You've discounted it because it's illiquid. You don't have control. So it's not free market value, and you could justify the lower value. Huge.
Right.
Never heard that, Seth. Awesome. Go ahead.
And you've got to use the right qualified appraiser. You can't have a real estate professional just drive by and write a paper. It's got to be a full study, and you're going to get two bites at the apple. First bite's going to be on a professional real estate appraisal. They're going to look and value the dirt, and then you're going to value the LLC. Once you value the LLC, that's where you'll get that 30 to 40% discount for real estate. And real estate's a great asset because it's illiquid.
Huge, 30 to 40% discount on the value, folks. That is huge. Whether you move it to your estate, trust, family. Come on, that's huge. Go ahead.
That's big. So here are the two
stuff, man.
It's real. Listen, add zeros.
I didn't know that.
Numbers.
Yeah.
So here's the second part, which is exciting. Second part is you can either give it away to a family trust, and now you put that 50% in. We know the liquidated value. If you sold that $10 million portfolio, that's $5 million. You just had phantom assets of $1.5 million, $2 million end up in your kids' names in the family trust at no cost, and you save 40% estate tax.
My
the second thing we do,
right?
So I have a lot of my clients take advantage of the first step. They give it away. Now what happens is they gave away $15 million of assets. What can they do next? Well, once we have this trust seated with real assets, partnership interest real estate, that trust can be its own purchaser, and it can purchase the balance of the assets from the parents, from the grandparents, with a promissory note, an amortized note, balloon note, however we're going to structure it, regular commercial deal. But because the trust is what we call a grantor trust, which means it is considered due for income tax purposes, no gain or loss is recognized. So a sale to a grantor trust will not recognize capital gains. So you sell the remaining, $5 million of assets for $3 million to the trust. The principal, mom, dad, grandma, grandpa, they're getting cash flow. They're getting their note payments for the next 20 years.
Got it.
All that future appreciation is now stacked outside their estate. That's how real wealth is passed. And
right. That's huge right there. Okay, huge. I don't know if everybody understood that, right? But you're not paying the capital gain on the sale to the trust. And then the trust does a promissory note back to me, my dad, whatever, and gives you real income tax. Are you paying income on that? Are you paying income tax on that income?
You're paying income on the underlying income. So you're getting all the depreciation and all of the net income off the real estate, but not on the sale of the partnership interest.
Right. No, that's huge. That's how you preserve the value of the assets without paying capital gains tax. I get it. Got it. Go ahead.
What's number
3? Yeah.
You ready to supercharge it? Jerry, this is going to make you happy. You're going to get excited with this. Now you have a family trust outside the estate with a real estate engine generating cash flow, getting put into the family trust. You know what you buy with that cash flow? Life insurance. So now you're exponentially increasing the wealth of the family through the cash flow. You bought life insurance inside that trust, and then generation 2, 3, and 5 for 1,000 years in Florida can use that money to buy more real estate, buy more assets, and provide more wealth for future generations.
Right. And then the life insurance builds value. And eventually the person who's the beneficiary is the trust, correct?
Correct.
And
it's and here are the kickers with the trust. It's asset protected for the kids. It's divorce protected for the kids. Drugs, alcohol, gambling, anything that can go wrong in a kid's life, that trust through the trustee is going to protect those kids.
Wow. And so sooner or later, the trust is going to get the benefit, which could be $1 million, it could be $5 million or $10 million, whatever, depending on the size.
It could be $100 million.
It could be $100 million. Right. No. Listen, guys, this is the stuff you got to pay people to sit down with, right? A sophisticated attorney, which is only 1 out of 10, right? My school of thought is If you have 10 teachers, there's only one really good one. If you have 10 attorneys, state attorneys, there's only one. And if there's only one insurance guy, it's the same thing. So, and most people do not have access to that kind of information. And really, it's difficult to get to a guy like Seth, right? Because they don't know him and so forth, because he's got a line out his door. So I just, again, subscribe, pass this along. These are huge, huge things, and so on and so forth. So just real quick, right, for the audience, Seth, who is your ideal client? Right? Because I know you're not going to take some guy with a fourplex, for example, or some, beginner. I don't know that. Who is Seth Ellis's ideal client, even entry level, all the way to the top?
So two different target points. First, Jerry, you're my ideal client. You're always in the business, you're entrepreneurial, and you're always looking to make sure you're protected and you have the conversations before you jump. So a client that's willing to take the advice, that's like key in our world, because it's really hard to like make it work after it happened. But if we can plan properly at the beginning, set up the right structure, and time is your best friend. The older and colder these transactions are, and when the entities were set up, the stronger the asset protection is going to be into the future. And we do need to talk about an asset protection trust in a second. So my key clients, entrepreneurs, anyone that's starting a business, that has a business, or is thinking about passing wealth to generation 2 or 3, those are the people I love working with. And anyone that has a complicated estate plan, anyone that has children with issues, family with issues, or people that are thinking more of the unusual stuff. They want to benefit charity. They want to benefit foundations. There's things that they want to do that, isn't your vanilla stuff. I love rolling up my sleeves, sitting down with the client and strategizing on what we can do.
But I mean, for example, when should investors start planning for generational wealth structure? So for me, obviously, you and I know each other. I own multiple business streams. I've got, partnerships. I've got limited partnerships. I own real estate, but I also have businesses that are generating. But when does a typical entrepreneur, somebody who's buying his first fourplex and maybe owns a dry cleaners, when does that generational wealth structure, when should they start? Because I keep hearing, because I'm listening, is the sooner the better. If you wait too long, that's your biggest problem. Am I right?
You start at the beginning. If and I love these meetings. I mean, I love sitting down with someone who's just starting off buying their first property. Listen, if they're going to buy one property and it's grandma and it's going to be, a rental property, that they could put on Airbnb, not my ideal client. But if you're going to start with your first, duplex, fourplex hotel, and you want to start building and you have the vision to build, I want to be there with you. And I want to spend the time at the beginning, because with the proper structure, we can avoid costs, taxes, and exposure to creditors. Because once you file your name on a deed, once you put yourself into public records, in this day and age, there's no escaping it. You can't unerase it. You can't unring that bell.
Got it. Understood. Okay. No, that answers my question perfectly. So it's anything. I mean, we deal with family offices, right? And I've, believe it or not, I see the lawsuits because they come in on the real estate side with the insurer, or we see the product liability on their other businesses. And I can't tell you, about 80% of the people, they come to us to make the insurance payout. You want to know why? Because they never spent the time on the proper estate and asset protection, and they find out only during the lawsuit. Even family offices that are worth 100 million plus, right? And then they come at us, right? And I've seen it happen. And they're like, Jerry, give me your E&O policy. I'm like, me? It's not my fault you didn't have asset protection in place, right? so it
Here's
happens.
a letter.
Yeah, no, it happens. And then I call Seth and he defends me. No, that's another story. Okay, cool. So you were about to go into something, so let's not forget that, right?
Yeah.
You mentioned, but actually, let's go there. And then I'm going to ask you, I want you to give me an example of the worst thing that you've seen, and just so people get it, right, in a story, but go for it.
All right. So we started off talking about that single piece of property, and I recommended a land trust owned by an LLC, owned by a holding company. But here's the problem. I told you a few minutes ago that with a holding company, you still have creditor exposure because they can get that charging order. So what I do with a lot of my entrepreneurs, and again, old and cold is the best defense here, is we'll use Nevada or South Dakota and set up a trust to hold that piece, that holding company. So now what happens is holding company owns the partnership. Sorry, the holding company is owned by the Nevada Trust, which is a domestic asset protection trust. And if you get sued outside of the real estate world, which happens, whether it's going to be divorce or your neighbor is upset where the fence is, you get sued, they can't go into the structure. So if you set up a Nevada trust, you transfer assets into the Nevada trust, after 2 years, that trust is seasoned. And if you get sued after 2 years under Nevada 160, Chapter 166, creditors are not able to pierce that trust. There are certain exceptions and things, but I'm not going to get into that now. But in general, Nevada has a 2-year, South Dakota has a 2-year, New Hampshire, Alaska has a 2-year, I believe. So what will happen is in year 3, you get sued. They file the lawsuit in Florida, they litigate against you, they get a judgment against you. You then say, sorry, no assets, go to Nevada. They have to go to Nevada, they litigate in Nevada, and try to domesticate their judgment. And the Nevada trustee is going to say, sorry, 2 years have passed, I can't give you any money. But Jerry,
Wow.
if you need your car payments made, or you need your boat payments, or your insurance paid, or you need, your family vacation for $100,000 to go on a cruise, we can pay your vendors. We can pay those directly for your benefit, but we're not going to give you a check for $100,000 that a creditor is going to take. So when you stack all these things together, it starts to build that, that huge moat between land and the castle.
Right. Wow. No, that's huge, right? Because creditors come, and some creditors, even general contractors, right, that you have a discrepancy with, especially on real estate projects, right? They come at me for a $150,000 contractor lien when he didn't even fulfill his obligation, right? But if it's that difficult, they can't get there, right? And that's what I'm hearing at the end of the day. And listen, everyone out there, you guys know, and for the beginners, the more money you have, the more you're subject to lawsuits. It's a part of our life, right? So when I got my first couple of lawsuits, right, from tenants, and most of them, they're looking for checks, right? So, and that's what happens. You become this target. In today's age, I'm used to it, right? Like, because it's a part of wealth. Wouldn't you agree, Seth? They just come.
100%.
And we're ethical. We're honest. We only do business with people with value, ethics, good integrity, right? That's why Seth is my friend and vice versa. And these people come, man, out of the woodwork. So go ahead.
Jerry, it's a line item on your budget, litigation costs, attorneys, and
100%.
settlement costs.
Right.
It didn't always be like that, but that's what we're looking at.
Right. So take us through real quick, because this is a guy who hasn't, lost a dollar for a client in over 10 years. So the point is, take us through one of the biggest mistakes you've seen, right? And what happened, just so they understand and maybe can, they're maybe in that type of structures. Tell me one of the biggest mistakes you've seen.
So I'll give you a few, but the one that's current in my mind is I had a client that, high net worth client, goes into a partnership with one of his best friends, buys a boat. The two of them are on the boat together. They took it in joint name. Sunday afternoon, friend takes the boat out with a bunch of people. Accident happens. Somebody got killed. And my client is now struggling to figure out how to protect his assets because he's expecting a multi-million-dollar lawsuit. Had the boat been in an LLC, it would have been protected. Had they had a clear delegation of who was responsible for certain things, it could have been protected. But that's one that just happened recently that I'm working on, and we're looking now we're looking at how do we move some of these real estate properties that he had all in individual name into either LLCs, and what the exposure risk is by doing that, or putting it into, he's not married, so can't put into a wife name. There's no tenancy by common, tenancy by the entirety protection. So and the worst part was he didn't declare homestead on his primary residence because nobody told him to. So
Oh my God. He has no homestead protection.
Well, we're going to argue there is, but you don't have to actually file with the property tax people to say you have homestead, but it's a question.
Right.
The other thing which I see happen,
that's big mistakes there. And listen, I know young entrepreneurs in EO, right? They just partnered on boats. They don't think about this stuff, especially newer wealth in younger entrepreneurs, right? Like my boat is an LLC. It's considered a business for charter, and my company rents it. And it is. And then we rent it out. But listen, that happens every weekend. Wow. So thank you for pointing that out. Pay attention, folks. Go ahead, Seth.
the other thing which was worked out well in the end, but it was a real nightmare going through it. I did a strong asset protection case for a client. signed an affidavit, told me he had, no debts, everything was fine. 2 weeks after we signed all the paperwork, I found out that he was in litigation with a bank over a loan. He copped the judgment to the bank, and they went to execute and unwind everything we did. However, once they found out that he had put substantial wealth in Nevada and had put it into the trust structure with an LLC, not a real estate guy, but just a regular entrepreneur, he was able to negotiate $1 million debt to a national bank for $100,000. So that was what could have been a really bad situation because we didn't run any of the time statutes, but just facts and circumstances played out for this guy.
Wow. So it's just crazy, man. What else you hear out there, right? And obviously the best success cases are the ones that you did all the estate planning and everything that we're talking about, and they backed off, just like you said, and so on and so forth.
And that's really all asset protection is giving you the ability to negotiate your way out of a hole.
Right. No, and I'm hearing that you're litigating even on the big mistakes, right? And you're able to come up with creative ways for people that didn't think about this, didn't think it through. And I can't tell you that happens all the time. You're helping them out. That's what you just explained, right? And trying to backtrack it. Yeah.
One clarification. If you show up my office with a lawsuit that's actually been filed that we know about and you've got real exposure and it's there, we're not the right people for you. I want to work with entrepreneurs that are worried about the future and want to plan properly, not the ones that are reacting because, they just got served with a multi-million-dollar lawsuit.
Right. No, I get it. Right. So what I hear is ROI, right? Return on investment, right? So obviously I bring people in on my team, right? I've got a COO, I got a chief technology officer, I've got an estate and trust attorney, Seth, I've got an insurance guy, right? And a lot of times investors are thinking, what's the ROI? If I got to pay Seth $25K, or if I got to pay Jerry a $15,000 consulting fee to make sure my insurance aren't full of policies, what's the ROI, right? So the ROI for Seth, let's say it costs you 25 grand to do all your estate. I don't know. I'm guessing, right? Because if it's a sizable estate, I'm not talking about one fourplex in one business, right? So 10 properties, whatever it is. What's the ROI on that? And how many investors make mistakes thinking cheap, right? He's in the insurance business. This is my take from this, right? Your bank is forcing you to buy wind insurance, to buy terrorism insurance if you're using Fannie and Freddie and CMBS lending, non-recourse, right? All of these things. The odds of those claims are 0.0001%. And you're forced to spend $80, $100, $200, $300,000 on insurance. But is your estate, is your wealth, is it protected? So give me a little bit of how does that work with that when it comes to certain clients and things of that nature? Right? When it comes to, do you see a lot of clients not investing in this type of insurance policy and so on?
So I agree 100%. Once it's explained and once we kind of identify what the liability is, they're going to decide what to do. I always start off with, listen, if you're going to buy a piece of real estate, put in an LLC, and then we can go from there. Set up your foundation, set it up properly. And then each piece of it is just an additional insurance policy. What's your risk? What do you want to protect? How do you want to protect it? And, when it is explained properly and when a client is aware of what goes wrong in the world, it's an easy sell. It's not, it's 25,000. It's like, it's 25,000. I mean, it makes sense. That $25,000 investment in this legal structure could save you hundreds, if not millions of dollars into the future, especially if you get to keep your building and you can work out a deal with the creditor.
Right. No, that's huge. That's huge. Okay. So for example, you see all these lawsuits happening right now and you're on the front, right? And he obviously knows about the big, beautiful bill, right? Our buddy up there and so on. So what new trends are you seeing for asset protection going into the future? What new lawsuits, what new, style, because you're cutting edge, right? What's the biggest new risks, the biggest new lawsuits, just to keep the audience kind of aware? And what's the future trends of what you do and what should be protected? Give us a glimpse into your vision into the future.
So, we start off with the basic ones, which are your slip and falls and all of this. I think one of the things that you're going to be concerned about is going to be probably with cryptocurrency and how it's being used to purchase real estate. If it's being used to purchase real estate, I haven't had tremendous exposure to that yet in this world, but I think that's going to be where a lot of fraud could potentially come in. I think that
Interesting you
look
just
at,
say that real quick, Seth, because that's big. So I just debated Gary Cardone, which is Grant Cardone's. The video comes out today. And if you guys want to check out that video, there'll be a link up here in this corner. So I just debated, I was asked to debate Gary Cardone. He's Grant Cardone's brother. He's a Bitcoin maximus. He's made hundreds of millions in Bitcoin, right? And then there's another gentleman, Dustin, who has been debanked, and he built the wall for Trump. He gets government contracts. He's only in Bitcoin and so on. We just had the debate. You can watch the video here. And he's responsible because Grant and Gary have now just launched a Bitcoin real estate fund, first of its kind. So we just had a debate, and you can watch it here, on diversification or all in on Bitcoin. So it's interesting that that fund buys 80% real estate assets, 20% Bitcoin assets, and then they take the cash flow and invest it in Bitcoin. And then you just brought that up. And I bet we can get back on the debate with them because they're not thinking about these ramifications. So if you could talk to that point a little bit, I think it would be great value for that crowd. And I just got off that debate.
I'd like to listen to the debate first before I bring it up, but
Okay.
which one comes first?
Listen, you hit a great one. Go ahead. Yeah.
Yeah, no. So listen, I think there's going to be a lot of opportunity for fraud in that world, and I also think that there's going to be an opportunity, on being able to hide that those funds coming in as to who's actually making those purchases, and that that's going to be I think a concern for us. Other trends that are out there right now, Jerry. I mean, it's all the basic stuff when it comes to real estate. You've got your loan covenants. Are you, when you're doing these loan applications, are you stating the right net worth? Are you stating the right issues? Are you creating liability? And how do those disclosures play into the actual ownership and takedown of the real estate? And usually it doesn't come into a problem unless there is a problem, and they start looking at stuff like that. In South Florida, I'm seeing a lot of issues with people dealing with with homestead related real estate purchases, and putting where they've kind of gone from the first house to the second house and third house, and they're starting to put assets into LLCs, and they're getting they're hitting new property appraised values. That's always stressful for real estate investors.
Tell me about it. Correct. Yep. They're doing it all the time. They just reassess me. And then the homestead thing is, the transfer. No, I get it. Okay. Sounds good. So, listen, because like ADA lawsuits that came out of the woodwork 10 years ago, right? So there's always this new lawsuit that you got to think about, and he's on the front line. So thanks for sharing that. Glad you brought up the Bitcoin too, because once we watch the debate, maybe we can do some homework, and then I'll get those guys back on, right, with UV and so on, because these guys, they think they're being Bitcoin and on the blockchain. They think they're like no one could touch them. And one guy's literally debanked by the federal government. He lives in Bitcoin and a little cash fiat. So, and these are big people. He was part of a Trump government demonstration on January 6th after, when they stormed the Capitol building and so on. But they're good guys, and they believe in freedom, right, and asset protection. So we're going to bring Seth out there and so on. So listen, I looked at your website earlier. You have something, right? It's called like the one-page blueprint. Is that still around? So investor trust blueprint, or am I wrong? If not, we'll cut this out. I can re-ask the question. Cut it out. Okay. All right. Okay. So cut that out. All right. So now this is all you and me talking. We'll cut it out. I'm going to ask you, how do people reach out to you? What's the best way to get to you? Is there anything you want to offer them? Do you have anything in your website? Go to my this, download this, if you need this, right? Or you just want to say, reach out to Seth, blah, blah, blah. Anything?
Yeah, I'll give my direct email. If you guys can, post it afterwards, and also my website, they can go on and chat there. We have a lot of information.
So I'll just
there.
ask you. Okay. So, all right. So, all right, Seth, man, there is so much information here. We could probably keep you on for the next 3 hours. And I will tell you guys, the audience, you got to listen to this, and it's in the details and things of that nature, right? It's about future proofing wealth and your portfolio from tax, estate, across the board. If you don't have a guy like Seth Ellis on your team, you're exposed, and you may give away generation wealth that you've been busting your butt for who knows how long, or your parents and so on, and give it away if you don't have a person like Seth Ellis on your team. Seth, how does the right client get a hold of you? How do they reach out to you? Go for it.
So the easiest way is jumping on our website. We have a direct chat line on our website, which is ellis-law.com, or through my email directly, seth@ellis-law.com. And Jerry, listen, one of the things in the way I built my business is it's one client at a time. I'm happy to sit down with any one of your followers, any of your clients, sit down, kind of map out a strategy. Once we map out that strategy, I will then, give you a flat fee to do that work, or arrange to do that work. But it's important to have that dialogue. And I don't want, a lot of asset protection attorneys are going to say, oh, I'm going to charge you $1,000 to come and sit with me. I'll sit and talk to you, whether it's on Zoom or whether it's in person, and we'll figure out a solution. And then from there, we can figure out the right price.
No, that's awesome. Right. So as you guys know, we do what we call the pay it forward. We build strategic partnerships with, the same ideal client. So obviously I'm an ideal client of Seth. Seth owns real estate. His wife owns businesses. I know them for years. They're all entrepreneurs and so forth. So we create ecosystems. So our ideal client is high net worth commercial real estate investors and entrepreneurs. I'm in the insurance space. I am that client. Seth is also his own ideal client, right? Him, his family, his wife. The difference is we share our values, right? We share our ethics, our integrity, and we expect our clients to also, because we don't work with people that don't. So the point is we create these ecosystems of strategic partners. So on our website at Premier and Real Estate Profit Boost and jerrykatzceo.com, we have our list of our trusted strategic partners. They're all on my podcast, from Kelly Grant Law that does 350,000 evictions a month, right? He's in your neck of the woods. So that's what's important about these vetted individuals based on ethics, expertise, and at the top of the game. And there's no coincidence that this guy is a fiduciary for over $1 billion in assets. So if you own real estate, and believe me, and if you think an LLC protects you, you are probably wrong. Seth Ellis manages over $1 billion in assets. He's seen it all. And today he's breaking down these real estate strategies, especially for our client base and for high net worth families. So if you want to be protected from lawsuits, taxes, divorces, probate, you go to the description down below. All his contact information is there, his name and his email. And then you tell him, when you send out that email, we found you with Jerry Katz on Real Estate Profit Boost. Seth, you're the man. Thank you. Love it. And by the way, thank you for being, to make a fixed, he's willing to sit down with our client base, right? And I'm talking to our audience, right? Not everybody. The rest, you click the link for free. Why? Because it's built on trusted confidence and relationships. So I want you to know that. So once again, thank you, Seth. Appreciate everything. You're the man. Peace, love. Another episode of Real Estate Profit Boost.